So I actually make more money by a long way in bear markets. So bear markets for macro people tend to be very interesting. So if you think about a bull market, they tend to be long, and let's say they go up 10% a year,
Okay.
or 15% a year, something like that. That takes a long time. Bear markets, you probably get a 50% return in a 6-month period.
Yeah.
So with the ability to use futures or options, particularly options, you can take hugely leveraged bets in a very fast moving market where the markets have underpriced this risk. So that is where, when you're looking at the indicators, particularly around recessions, it's hard around geopolitical events and stuff because they tend to be more randomized, but recessions tend to be forecastable. And around that, you can start positioning yourself. So we're starting to see it happening in the US right now. We're starting to see the yield curve turning lower. Usually when the yield curve goes negative, a recession follows soon after. And then a bit of technical analysis will give you the timing. Now, there's no 100%, there's no certainties in this world. All we do as investors is look for putting probabilities in our favor. And the more experience you have doing that, the better you get at it. And the pandemic was one of those very obvious setups for us in the macro world. The economies globally were already slowing down. We'd had the trade tariff wars with China and the US. Trade was slowing down. Then the pandemic arrives. You saw the outcome in China, which was lock everything down. It went to Italy. Italy did the same. The moment that happened, you knew the whole world was going to follow suit and close their economies. And that looked like, okay, this is a macroeconomic event that we can not only hedge ourselves from, but actually profit from. So this is the hard part. It's the same with any technology company. Is it going to get adoption? So this whole world is all about Metcalfe's law. Now, there's no easy Metcalfe's law, just plug it into my computer and it gives me a fair value, right? So you have to estimate it. And you're estimating it by looking at, is the network growing? Are people building things on it? So you make some forecast based on that. So like you'll see tokens like Shiba Inu that retail are trading. And you have to ask yourself, is that really a network or is that just a speculation? Now, in most cases like that, it's just speculation. That's fine. People want to speculate, do what they want, but you're not going to build long-lasting value. So over time, they trend to zero. But what's interesting was the other one like that was Dogecoin, which was this joke crypto that everybody found as a meme and they liked it. It was kind of fun and it's kind of a bit weird. But a lot of people invested in it. And so this was looking like it was a potential disaster in the making. But then Mark Cuban, a famous US investor who owns the Dallas Mavericks, which is a Dallas basketball team that's pretty famous, and he's a very famous guy. He said, you know what, if you guys all own it, we're just going to accept it as payments for anything to do with the Dallas Mavs. And then Elon Musk said, well, if you guys love this, we're going to use it too. Ethereum, very straightforward. Everything's happening there.
Yeah.
The network's growing, applications learn. So, okay, so how does the average person figure out if this is working? And there's an easy hack. So go back to the charting, my technical analysis. All of these assets, these digital assets, Metcalfe's law is exponential in nature. So it means when you draw a linear chart, it always looks like this.
Yeah, yeah.
But most people go, it's a bubble. It's an endless thing. It's a bubble. It's a bubble. And you would have done the same with Reliance. You would have done the same with Google, Facebook, Tesla, all of these. And you would have got them wrong every time because these were network stocks. So what you do to value a network stock is change the scale on your chart to log scale. And then what happens is magic. Most of them end up being in this beautiful channel.
Right.
And they go up and down in the channel. That channel can be 50% because it's log scale.
Yeah.
But the channel essentially shows you network adoption. Right now, if you take the chart of Facebook since inception, put it on a weekly or monthly chart on a log scale, it's actually breaking its log channel. So what it's saying, and this is another important thing when you're analyzing technological investments and in crypto, is something called the S-curve. These are risky assets, which is why they have so much return, but they're risky. They can also go to zero. And the S-curve is the classic moment when this new technology gets tested by the market or by the users. And it either survives it, and in which case you get the Lindy effect, which means it strengthens the value of the network, or it fails. It's happening everywhere. So if you need to understand how the crypto space is.
Yeah.
These cryptocurrencies like Bitcoin, particularly Ethereum and others, Solana, AVAX, Luna, these are the blockchains on which the applications are built.
Okay.
They're not the applications themselves, but they are networks, blockchain networks, that if we buy the token, we're participating in the network. So if you imagine that Facebook, the network owners are the people who own the shares. We as users of WhatsApp or Facebook, we just get the utility, but we don't get any value.
Right.
This new world of cryptocurrencies, users have a token, so it goes up in value. So everybody's a participant, an economic participant in the network. But that's that. They're called layer ones. What's interesting is cryptocurrencies are international products, and they tend to be anchored in limited supply. So Bitcoin has only 21 million Bitcoins that ever be created. So you have a digitally scarce asset, kind of like gold, but it fits in this new digital India world where, all of these things can connect easily. People are used to wallets and transactions and those kind of things. So it allows you to put savings in something that doesn't get devalued over time via inflation or falling. So that is that, but it also is another thing, which is basically it's a call option on this new technology, blockchain. So you're getting this store of value. So if we look at Amazon had a very big S-curve in 2001 too. After the tech crash, most things were going to zero. Amazon was still a bookseller. And everyone was like, should a bookseller survive this? And it fell 95%. But it didn't go bust. And then it recovered. And it started having these waves. And the waves were, suddenly it was trading on a P of 800. And people like me were like, this is ridiculous. It's a bubble. What we didn't realize is the market had started to figure out that it was more than just a bookseller. It could have the opportunity, the probability of becoming a massive online retailer. That starts happening. Then the market starts saying, well, it's an online retailer. It'll never beat Walmart. And then it comes out with AWS, the cloud server. And before you know it, these S-curves get smaller and smaller.
Yeah.
So what we've got in Facebook right now is an S-curve. The entire bet on Facebook is, are we oversold in that logarithmic channel? Is this S-curve the death of Facebook and the death of that network? Or is the market mispricing the new opportunity? So there is a secret here. There are two types of drawdowns that you get. You get corrections and you get economic bear markets.
Okay.
Right now, across the world, we've been seeing markets sell off. Well, if we go back to my framework, the ISM is still positive. Global growth is still positive. Yes, it's rolling over. Yes, the yield curve's coming, but none of the economic signals are there. You have to be quite lucky to capture those events.
Yeah. And
I would say I probably get, it's a very 50-50 hit rate, maybe less.
Okay.
Of those kind of corrections you can spot. They tend to be technical analysis, but you often have many false starts, and then finally it happens, and they're not great. If you get the other one, which is all the economic signals stack up, then I have 100% hit rate.
Sure.
No, that's 100% would be fair. I'm always early. So give me maybe get stopped out once, give it a go once, maybe even a second time, but the third time you make all the returns. So you might, lose 2%, lose 3%, make 30, 40%. It's thinking of the risk returns, but just picking market corrections unless you're a really good trader, I tend to be slightly longer term. I tend to be 6 months to 2 years is my time horizon. Our ego wants us to pick all of these because it makes you feel good, right. Bears always sound smarter, and I've been a bear, a lot of the time. But realistically, you're better off to buy the dips than to sell the rallies. And